Okay, good morning and welcome to the Financial Juice live morning briefing with your host, Tony. So, the title of the day is Where Are You Taking That Money, Kids? Now, that's in relation to the European Union. They had their virtual meeting yesterday to discuss how much money should be pumped into the economy and whether that'll be up to 1 trillion euros or even more. And here's the issue. One of the issues being is that they said that they have announced that there would be a package, but what would that look like? Would that be mostly made up of loans or grants? Those are details that we hadn't received from the European Union yesterday. So one of the headlines that I wanted to just go through from one of all the reaction of the Eurostock 600, if I just bring that chart up for you here. All we can see is that European shares slide as stimulus fails to impress. Now, after weeks of squabbling, EU leaders approved an immediate rescue package of about 500 billion euros, but left the decisive details of a bigger fund until the summer, sending the Pan-European Stock 600 index down 1.2% in early trading. So this is what we can see from the reactions so far, is where if we get to the dates, let's have a look at. Okay, all right. So here we go. We get to our high point on the day for the 23rd of April, and then what happens is we see as this news comes out that the European Union has approved some sort of trillion euro fund, but they don't know what that looks like, or they have not shared details of what that will look like to traders and the rest of the world. You saw this negative reaction on Euro stocks, where we saw a movement of altogether a downward movement of over 2.5%, which isn't a positive sign for the markets, also for the European Union itself. Now, if you're thinking about the USA, they've been open and to how much money they're looking to spend on certain things. Compare that to the European Union, they haven't really done so much of that as of yet. So this is why we're seeing, again, the USA's condition is not as good as we'd hoped it to be. But we'll go through that in a bit more detail. But for the European Union to continue to squabble and not release details, it doesn't bode well for the markets, and it shows in the reaction of the markets here. If we also took a look at the Euro USD on yesterday as well. So when I was giving out some headlines coming out from the EU about the EU not revealing so much about the 1 trillion euro package, beforehand we started to see some movement towards the downside. But as the news was released of the 1 trillion euro package and the continued squabbling of not being able to agree as to what that package would look like, then you saw some continuing downside movement on the euro. And that's so from around here is when the news had popped out. If I just zoom out and we see the total movement. So from here, around here, the news, and then all the way down here is where we got to, down by over 0.5 percentage point. So again, not a positive sign for the euro or euro stocks, but we're seeing a bit of a rebound today on the euro. So far, we've got to a high point of 101.080. We'll see where that market reaction goes, but that's where we currently sit at the moment. We're just seeing some upside movement on the euro, seeing a bit of a reversal of this negative trend that we saw here yesterday. Again, just keep that in the back of your mind. We did on of the euro news. So other bits of news now. You've got France's President Macron, who said we need a coronavirus rescue package worth 5 to 10 points of GDP. Now, total Euro GDP in 2019 was around 18 to 19 trillion euros, right? Now, if we're thinking about 5 to 10% at the high point or at the most, Macron is looking for a stimulus package of around 1.8 trillion euros. Okay. Now, they've already said that they would want a 1 trillion euro package, but they don't know what that looks like. So even then, so what Macron has said is that there are disagreements over the size and shape of the rescue package that persisted, adding that the European project had no future if member states failed to respond to the exceptional shock. Now it's a high. So here are the two scenarios. One, you have the European Union approve this huge package, even without us knowing what it looks like, and then you see the fundamentals in the economy start to pick up, and as the fundamentals in the economy start to pick up, then news will come out of what that package would have looked like, and what it does look like, and you would start to see some positive reactions in the markets from the euro. Now, that's a negative case. That's a scenario which is positive, but you don't really want to see. You want to see politicians being upfront and open as to what they've discussed. Okay. And that will keep market sentiment positive. But working around like this, where you're not revealing details or unsure and squabbling, this is why you see this negative reaction in the currency, and also in Euro stocks as well, or European indices as a whole. So that's one case scenario. Now, the positive case scenario is where you reveal all the details and you see that continued positive sentiment. Fine, that's one side. Second side is you continue to squabble and you don't come to an agreement. And that's where you see continued negative reaction, not only in the euro and in European indices, but also in your economy as well. The longer you take to pump money into an economy to keep it afloat, the harder it becomes to take that economy out of the abyss and bring it back up to a position where it can actually recover or have any chance of recovery at all. So if Macron is threatening, or not threatening, is just warning that the European Union could collapse if the EU leaders don't come to an agreement, then it's quite a big sign here that is obvious, but from what we're seeing so far, has not been heeded too. So again, just keep an eye out for any more comments from European members, or from the ECB. Don't forget they have a lot of firepower that they have left to throw at the European economy. Of 750 billion euros was the first package that they chucked at the economy back at around in March. Is what they did. Even though they didn't cut rates, they took the QE route of supporting the economy. Now, one of the things that I want to show you is talking about coronavirus cases and not going into lockdown. So, Sweden has controversially resisted locking down its economy, like its Nordic neighbors, such as Finland, Norway, and Denmark. This has contributed to more confirmed cases, but the country has a larger population, meaning that the figures look very different on a per capita basis. Significantly, the curve has flattened in recent weeks, raising hopes that the lockdown easing measures taken by European countries this week can be sustainable. So let me just bring up the image for you guys to look at and understand what is the possibility of coming out of a lockdown if we were to follow Sweden's lead. So this is their figures so far. What you can see is that they reached their peak. They reached their peak around the same time other other nations had reached their peak, other neighbors, right? Now, the only thing is that the pressure on health services would be quite substantial, as the more people who get the coronavirus disease, that means there's more likely of a chance of them ending up in a hospital bed and having to try and to combat it to stay alive. But here, what we can see, so the daily new confirmed cases of coronavirus, we can see that Sweden reached its peak quite quickly in number of confirmed coronavirus cases. Now, again, it's quite a tricky situation. You either have the choice of opening up lockdown measures, where in the UK it is supported and you've got most of the population, or nearly all of the population, adhering to the rules. The only thing is that if we were to say, okay, let's be like Sweden, what sort of backlash does that do for the UK government, and what does that mean for all the stimulus that is provided by the government so far to small businesses? So those are some of the questions that are in the back of my mind. So one, if you open up the lockdown, you're going to see a definite increase in the number of coronavirus cases, but on the flip side, what that means is the quicker you reach the peak, the sooner you're able to see a decline. However, if we see that peak rising quickly, then that puts a lot of pressure on the health services to deal with any patients. So you have some clear pros and cons of opening up a lockdown. But one of the other pros is that you can start to get your economy back up and running, and again, you can still put in social distancing measures. I don't think you would take those away if you're trying to open up your economy again. But there's got to be some systems in place to do that. And again, that's something that we'll look into further down the line as we reach the peak within the UK and we see a decline in figures. Okay, just some other things as well I wanted to show you. So, global economic contraction is to be the steepest on record, and recovery is U-shaped. So this is according to several Reuters polls. Over the past 2 months, economists who are generally more upbeat about the economic environment have turned extremely cautious, with an increasing number of them slashing their already bleak forecast repeatedly for developed and emerging economies alike. Also from this Reuters poll, a gross domestic product forecast for all 42 economies polled by Reuters this month were downgraded for 2020, and for exceptions for next year were modest at best. So 90% of economists, or 147 of them, said the risks to their forecasts for the second half of 2020 were skewed more to the downside, and that seems reasonable there and realistic. 20% see a V-shaped recovery, 15% see a tick-shaped recovery, about 5% a W-shaped, and about 4% an L-shaped. So an L-shape, you see an economy drop off and it never recovers. So that's about 4% of what people are predicting there. About 56% saying that there's going to be a U-shaped recovery. Now, if we were to think about where we sit at the moment, so after this lockdown stuff comes or finishes, and economies slowly start to pick up, but then what you will see is a rebound in the number of coronavirus cases. That's a definite thing. And then you'll see a little bit more of contraction happening within an economy, and then you'd see a full swing back towards the upside. And this is what 56% of economists are predicting as well. Now, if we looked at the charts, we brought up, let's say, we brought up the cable, that being the interesting thing this week in the UK, as the UK government has been accused of not performing or not dealing with the coronavirus disease itself and being quite late. This is what we can currently see at the moment on the cable. We did see that strong negative reaction or downside movement on the cable. One, that's off the dollar becoming king, and everyone moving their money out of their own currencies into the dollar, which is mostly traded around the world. But now we can currently see, what we can see is we're holding steady within this sort of range here, top of the range there. We're not seeing too much drastic movement as of yet, but that's just something to keep an eye out, as that we do have a long way to reach or to get back to before 2020. So getting back to 135 is going to be quite a pain for the UK. One, you've got Brexit talks, which are going to be quite slow due to the video conferencing and social distancing measures. And also the time frame that we have left. We have until the end of this year, December 31st, to get a deal sorted, and before we leave the EU completely for good, or maybe not for good. Again, that's another topic. So that's what we currently see at the moment. As I said, we've got quite a long way on the cable to get back to our highs of, or our high of 2019 at around here. Or at the end of the year there. So other bits, just some final bits of news as well. What we also look at here. So interest rates and assets. Now, if I just bring that up for you guys to look at here, this is where we see the Fed balance sheet and the ECB balance sheet as well. So this is the amount of bond buying that they're doing of corporate bonds, and as such, what happens is, or we can see, or what we have seen, is a huge blow up in the Fed's balance sheet of buying up a load of corporate bonds. So this has got to 6 trillion, nearly $6.5 trillion is what we can see. Okay, which is quite a bit of money from our point of view here. Now, what happens is, and then also if we're looking at the ECB as well, they've spent 5 trillion. Well, they have a total balance sheet of 5 trillion in total assets, right? Of what they've bought up already. And that's increased significantly. You can see here, so from April, that's what we saw, or around March to April now, we see a huge jump in the total assets. Now, what does that mean? Here's the thing. Now, when the Fed or a central bank buys up assets, what happens is that the interest rate, you see bond prices becoming more expensive. Okay, the more bonds are purchased, the lower the yield and the higher the price. What that does is the less money, or the less money that there is floating around, or the more money that has been chucked around by the Fed or central bank into the economy, that means that the interest rate becomes lower, right? As the Fed is pumping in QE, right, to save the economy, and other central banks such as the ECB, interest rates are low. The only problem is when we see really, really high amounts of Fed buying, of interest, of balance sheets increasing, at some point, the Federal Reserve will have to sell those assets. Why? Inflation happens. When inflation happens, what you want to do, what the central banks want to do, is control how much people borrow. If rates stay really low for a long time, then you're going to see a lot of borrowing happening, not only from commercial banks, but also from the normal everyday consumer as well. So at some point, this peak of what we can see here, this is why a lot of economists are seeing a U-shaped recovery, is because there's a lot of money that the Fed will have to, or bonds or assets that the Fed will have to move to stabilize the economy. And that would mean that at some point, as the Federal Reserve pulls their money out of the economy and relaxes the amount of easing that they're doing, interest rates, and they feel that the economy is doing better and they want to control inflation, the interest rates slowly start to increase. Okay? Now, here is the positive thing. Okay? So it's a positive thing that countries start to get back into the rhythm and the swing of things of building their economy back up. And you see productivity increasing as well, or coming back to life very, very quickly or slowly in some cases for a lot of countries. However, here's the negative flip side scenario of the Fed holding, or the central banks holding so much, a lot of assets underneath their belt, is that, one, don't forget you have governments also borrowing money and working with central banks to provide that money as well. So helicopter money, that's what they've so not helicopter money, but providing money to commercial banks to keep them liquid, so they can provide money freely to other commercial banks and consumers. That money will have to be paid back at some point to those big banks, right? As those big banks will owe money to the central banks for borrowing it. Okay, this is quite a negative scenario. The reason being is that if people have borrowed a lot of money, and interest rates rise as the central banks sell off their assets and remove QE and increase interest rates, people will have to pay more for the debt that they've taken on. And you see this new cycle of a recession where commercial banks and companies and corporations have borrowed so much money to keep their companies afloat that's left them with, you could say, a crippling depression for themselves, or a crippling recession where they're having to pay off that money, pay off a lot of money. So that's a negative scenario where you could see a new debt cycle being built up from that there in a lot of countries, not just emerging countries, but also developed countries already. So, however, on the flip side, to that scenario, a positive thing is that as countries get back up and running, what you do see is that the amount of debt that they have is easily offset by the increase in productivity or the return to productivity. That's a positive case scenario that you can see. And that's what a lot of the economists are hoping for, is that it doesn't fall into that 4% of what some economists are saying, where it'll be an L-shaped, where we will never recover. That seems too drastic. But we have this U-shaped recovery where things slowly start to get back up to speed. And that's what you want to see. We're not seeing that as of yet. In China, we'll hopefully get some really positive data coming out from them as well for next month. But that's going to be, as I said, it's going to be quite a while before we get to our pre-coronavirus levels. Okay, that is your market morning briefing. Don't forget to like, share, and subscribe to the YouTube channel of Financial Juice Support. It really helps to make sure that, one, I stay on my feet, and that you guys enjoy what I'm talking about, and it's helpful. Do leave a comment in the comment section as well. Let us know how you feel. What could we improve? What we're doing well. That'd be great. Thank you very much, and enjoy your Friday. Thanks.